Well, what lit up the equity markets? It was inflation data and retail sales that came out earlier this morning. Inflation data basically in line, but we did see a cooling on some metrics, particularly slipping from the previous month. Retail sales was surprisingly disappointing. We were expecting a little bit of growth, and basically there was no growth for the month of April. Let's bring in Andrew Szczurowski, co-head of mortgage and securitized investments at Morgan Stanley, for perspective on what we saw. And Andrew, it seems like the key catalyst for the rally today seems to be this idea that if you were worried that the Fed would have to consider rate hikes, this number at least softened that probability.
Yeah, no, first of all, thanks for having me. I think that you can kind of remove hikes from the equation. I think it's clear that the Fed, and when Powell spoke a couple of weeks ago, his preferred path from here is it's a question of kind of cuts and when those cuts come. And you're seeing obviously stubbornly high inflation, but the trend is in the right direction. And what the economy ultimately needs and what the Fed ultimately needs is time for those rate hikes over the last couple of years to actually filter through more and more into the economy. And again, it impacts certain sectors faster than others. But I think one of the keys here was that when the Fed hiked, there was a lot of consumers and corporations that were prepared for higher rates, and so they could weather the storm. But over time, it becomes harder and harder to weather that storm. And you're seeing transaction volumes in housing down. You're obviously seeing in certain parts of the economy, the low-end consumer is kind of getting more stretched. Credit card delinquencies are rising, auto delinquencies are rising. So I think I think last month you saw the bond market overreact a little bit to some of that stronger data. And I think from here on, you're going to start seeing the data kind of weaken as those rate hikes kind of weigh more and more on the economy and the consumer.
So what does that mean in terms of pricing and rate cuts? What's your base case?
Yeah, so this is something, obviously, we've had some wild swings this year on the kind of Fed rate cut front. And so we went from in January pricing in almost 7 rate cuts in mid-January to just to 1 at the end of April this year. So a huge swing from 7 to 1. And now you saw just in the last 3 weeks, 2 weeks, the market put another cutback on the table for 2024. I think where things actually get really interesting is in 2025. And that's when, you know, the market for this whole cycle is now pricing in about 6 rate cuts for the whole cycle versus 7 for 2024 alone. And I think that's where the value in the bond market lies, is actually kind of going out the yield curve a little, moving out of cash, and kind of lock in some of these yields we see today. And so I think that at the end of the day, you're going to see 2 rate cuts this year, 1 right before the election and 1 right after. And then next year, I think, is where the economy will continue to lose momentum. The Fed's focus will shift from inflation to the labor market and to the slowing economy, and then you'll see them kind of pick up the pace on rate cuts. So I think the real value, again, is not in 2024 for the bond market, but it's in 2025.
So, you know, we thought maybe there was a moment there where inflation would come down, but growth would hold up, a so-called no landing scenario. But what I hear you describing is maybe that soft landing is coming. It's just not this year. Perhaps it's next year. And we've seen, I guess, some signs of that, right? In the retail sales data and sentiment data, job growth was certainly disappointing the most recent month. Do you expect more and more data points like that?
Yeah, I think when you look at something like certain kind of survey data and economic surprise indices, they're showing that the U.S. economy is slowing. And I think the reason why it took so long is the consumer and corporations were working from such a position of strength. So we had all these excess savings that are now kind of the consumers work through. And I think at the end of the day, that those, as I mentioned, kind of higher rates, I think people were kind of too focused on some shorter term data. And higher rates, it does work. The Fed's kind of tightening policy does work. It just works with a long lag. And I think the issue is that this cycle, these lags were just quite a bit longer this time, and people weren't giving them enough kind of time to work. So I do think at the end of the day, if the Fed just sits here, you'll see the data continue to deteriorate, because again, I think it impacts certain sectors faster than others. But where those most interest rate sensitive sectors, I think that like real estate, you're seeing that has a big impact. You look around at kind of commercial real estate prices, that is having a big impact. And then in other places, you know, I think that there's a lot of lagged effects that we're seeing on the inflation front that I don't think the Fed has to be too concerned about. And that's something like one of the big drivers of some of these inflation beats more recently has been auto insurance. And auto insurance, when you think about it, it's a second order effect of the big price spikes we saw in used and new autos during the pandemic. And so we're working through that, but you're actually seeing new and used auto prices declining. So that's going to filter through in another year to lower auto insurance prices. It's just going to take some time. And I think the Fed knows if they can just sit here, the longer they wait, the data will come in their favor.
The market, and I'm speaking particularly about the S&P, has been pretty relentless in its move to the upside. Maybe a little bit of a wobble, but it rallied even as the prospect of rate cuts diminished, and the bulls hung on to the idea that that's okay because tech stocks might wobble, but cyclical sectors are doing well. Except now it's your more defensive characteristics that are rallying, like utilities, like real estate, like that you just mentioned. Is that a warning sign when you start to see those sectors start to outperform?
No, I don't think it's a warning sign at all. I think it's a sign of kind of more depth coming into the market at the end of the day. Again, some of these kind of most interest rate sensitive sectors that we're really looking for that kind of change from the Fed. I think there's going to be a tailwind over the coming quarters because I do think, again, I think the market's kind of underpricing the amount of cuts we're going to get from the Fed. So I do think you want to be in those kind of most interest rate sensitive sectors. I mean, on the bond market side of the equation, we like extending duration in our funds. It's something that we've been doing for some time. I think there's a lot of money that's sitting in cash that has been waiting to kind of move out. And I think you can't be late at the end of the day. There's not going to, if you wait for the first rate cut to come from the Fed, then you're going to have missed a substantial rally. And you see markets kind of swing pretty violently in both directions. They swung violently higher on the yield side in April, and now you're starting to see them kind of swing the other way in May. And I think if you continue to get a moderating of the data, you mentioned the labor market earlier. Again, that one of the big kind of savers there for the Fed, and that can allow for this soft landing, is actually immigration, where we've seen something like 7 million immigrants across the border. That's filling a lot of these kind of lower wage jobs that I think were hard to fill before, and it's bringing this labor market back into balance a lot easier than the Fed maybe was expecting just a year or so ago.